Wall Street is not just a marketplace. It is a factory. And the most profitable product rolling off its assembly line is the manufacture of hope. For the average retail investor, the standard stock market is painfully slow. An index fund might return 8 or 10% in a good year. It is a slow, methodical grind that requires decades of patience. But human psychology is rarely patient. When a trader logs into their brokerage account, they aren't looking for a 10% return in 12 months. They are looking for a cheat code. They are looking for a vehicle that can compress decades of wealth generation into a single financial quarter. The financial industry knows this, and so they created the ultimate high-octane financial weapon to sell to the retail crowd: the leveraged exchange-traded fund. These are the titans of modern retail trading. Tickers like TQQQ, which promises 3 times the daily return of the NASDAQ 100, or NVDL, which offers double the daily return of the tech monolith NVIDIA. The marketing pitch is incredibly seductive, and logically, it makes perfect sense to the untrained eye. If you believe the technology sector is going to go up over the next 5 years, why would you buy the standard index? Why wouldn't you buy the leveraged version and make 3 times as much money? If the NASDAQ goes up 10%, you go up 30. It feels like free money. It feels like you have finally found the asymmetric edge. But locked inside the prospectus of every single high-leverage fund is a silent, mathematical assassin. It is a structural flaw designed to slowly, ruthlessly bleed a portfolio dry, even if the underlying market is going up. Welcome to Case 018. Today, we open the file on the volatility trap and the hidden mechanics of high leverage. We will investigate the illusion of daily compounding, the fatal mathematics of beta slippage, and why holding a leveraged asset in a sideways market isn't investing. It is simply paying a daily tax on hope. To understand how the trap works, you first have to understand the fundamental difference between borrowing money to buy a house and how a leveraged ETF borrows money to buy the market. When you get a traditional mortgage, the leverage is static. You borrow the money once, you buy the asset, and the debt remains fixed while the value of the house fluctuates. But an instrument like TQQQ does not work this way. It does not simply borrow money once. It is a synthetic derivative vehicle constructed by high-level institutional quants. To achieve exactly 3 times the return of the market, the fund managers use complex financial swaps and derivatives. And here is the critical, fatal mechanic. The fund must perfectly rebalance its leverage every single day at the closing bell. It is called a daily reset. The fund only promises to deliver 3 times the return for a single, isolated trading day. When you wake up the next morning, the math completely starts over. This daily reset creates an incredibly dangerous phenomenon known as compounding. Compounding is a miracle when you are making a steady, unbroken profit. But in the violent, chaotic battleground of the stock market, compounding is a double-edged sword. And when that sword swings backward, it cuts 3 times as deep. When a retail trader buys a leveraged ETF and decides to hold it for months or years, they are entirely ignoring the daily reset. They are assuming the path from point A to point B is a straight, smooth line. But the market is never a straight line. It is a jagged, violent pulse. And that jagged pulse is what triggers the trap. In quantitative finance, the silent assassin hiding inside leveraged funds is known as beta slippage, or volatility decay. It is the mathematical reality that a portfolio loses money when it swings wildly back and forth, even if it eventually returns to its starting point. Let's look at the cold, unforgiving math of a standard, non-leveraged asset. Imagine you invest $100 into a standard index fund. On Monday, the market drops by 10%. Your portfolio falls to $90. On Tuesday, the market rallies and goes back up by 10%. Human intuition tells you that you are back to $100. But math tells a different story. 10% of your new $90 balance is only $9. So, when the market bounces back, your portfolio only rises to $99. The market went down 10% and up 10%, but you still lost 1% of your total wealth. That is the fundamental drag of volatility. Now, let's look at the exact same scenario through the lens of a triple-leveraged vehicle like TQQQ. You invest $100. On Monday, the underlying market drops 10%, but because you are leveraged 3 times, your fund drops a catastrophic 30%. Your portfolio violently crashes from $100 down to $70. On Tuesday, the underlying market rallies 10%. Your leveraged fund rallies 30%. You feel a rush of relief. But 30% of your new $70 balance is only $21. Your portfolio rises to $91. The underlying market is completely flat. It went down 10 and up 10. But your triple-leveraged portfolio is down a staggering 9%. The money didn't disappear into thin air. It was vaporized by the daily reset mechanic. For the quantitative strategists building automated market scanners, this crime scene can be explained with a single, brutal equation. The leveraged return is approximately equal to the leverage factor multiplied by the market return, minus 1/2 of the leverage factor, times the leverage factor minus 1, multiplied by the variance. In this equation, the variance represents the volatility of the market, and the mathematics prove a terrifying reality. The higher the leverage and the higher the volatility, the faster the portfolio bleeds to death. Volatility acts as a gravitational pull, relentlessly dragging the value of the asset towards zero. The absolute worst environment for a retail trader holding a leveraged fund is not a stock market crash. In a pure crash, you simply get stopped out. The most lethal environment is a sideways, choppy market. A market that violently swings up 2%, down 3%, up 1%, down 2%, for weeks at a time. During these periods, the underlying index might look incredibly boring. It might trade entirely flat for 6 months. But beneath the surface, the triple-leveraged ETF is experiencing the sideways slaughter. The daily rebalancing act forces the fund managers to buy high and sell low every single afternoon just to maintain their leverage ratios. If you hold a triple-leveraged asset in a sideways market, you are not investing. You are bleeding out from 1,000 microscopic paper cuts. This is exactly why Wall Street loves to sell these products. They are legally protected. Every single leveraged ETF prospectus explicitly warns retail investors that the product is designed for daily trading only and should not be held long-term. But the funds know that human greed is stronger than the fine print. Retail traders buy these assets, they suffer massive drawdowns, and they refuse to sell because human psychology hates to admit a loss. They become bag holders, trapped in an asset that mathematically decays every single day the market fails to break out. While the retail trader is slowly being bled dry by the mathematics of beta slippage, the entities that created the leveraged ETFs are getting rich. Firms like ProShares and Direction don't care if the stock market goes up or down. They don't care if the underlying tech companies succeed or fail. They have built the ultimate institutional toll booth. Managing a leveraged ETF requires complex daily derivative swaps, and those swaps are expensive. So, the fund managers charge incredibly high expense ratios, often 4 or 5 times higher than a standard index fund. They collect these massive management fees every single day, directly siphoning capital out of the fund's total value. Whether you win or lose your trade, the house always takes its cut. This is the bucket shop revival. They have repackaged the dangerous, highly leveraged gambling of the 1920s into a legal, regulated, 3-letter ticker. They are selling the shovels during a gold rush, but these shovels are designed to rust away in your hands the longer you hold them. The volatility trap provides a critical, undeniable lesson for the modern algorithmic trader. Leveraged ETFs like TQQQ or NVDL are not investments. They are not wealth generation vehicles you lock in a vault for retirement. They are surgical instruments. They are highly tactical weapons designed to exploit short-term directional momentum. If your Python market scanner identifies a massive, high-volume breakout, these vehicles allow you to capture extreme alpha. But the moment the trend breaks, the moment the market enters a period of high volatility sideways consolidation, you must instantly drop the weapon. If you attempt to hold a daily reset leveraged asset through a choppy, uncertain market, you are fighting a war against the fundamental laws of mathematics. And in the financial markets, mathematics remains undefeated. This closes Case File 018.